What if I told you that one of the most valuable companies in the world, a company that's been at the forefront of AI revolution, might be facing serious threats that Wall Street isn't talking about? Today we are diving into a fascinating analysis from Jeffrey Emanuel, a former hedge fund analyst, with an incredible and unique perspective. Why should you care, by the way? Because Nvidia, the company we're talking about, is now worth more than the entire stock market of France or even Germany. Its fate could affect everything from your index funds to the future of AI. So let's break down this brilliant analysis that combines deep technical knowledge with Wall Street wisdom. Who Jeffrey Emanuel is and why his perspective matters. Emanuel isn't your typical analyst. He has spent 10 years as a hedge fund analyst at prestigious firms like Millennium and Balyasny, where he honed his skills in evaluating companies and market trends. But what sets him apart is his deep technical background in AI, which dates all the way back to 2010, long before AI became the buzzword it is today. He's also launched multiple successful open source AI projects and is a two-time winner of the Best Idea Prize on Value Investors Club. So his unique mix of technical expertise and financial acumen makes his analysis particularly valuable for understanding Nvidia's position in the current market situation. Now let's dive into the bull case for Nvidia, the reasons why so many investors are bullish on this tech giant. The first pillar of the bull case is the AI revolution. AI is not just another tech trend. It's a really transformative technology that's changing every aspect of society, from healthcare to finance, from autonomous vehicles to humanoid robots. AI is everywhere, and with this explosion of AI applications comes unprecedented demand for computing power. Nvidia, with its cutting-edge GPUs, has positioned itself as the go-to provider for the hardware needed to train and run these AI models. Every time a new AI breakthrough happens, Nvidia's chips are at the center of it. The second pillar of the bull case is Nvidia's dominance in the market. They have a near monopoly in AI training infrastructure, which means they control the supply of the most critical component for AI development. This dominance gives them, for sure, incredible pricing power. They are able to charge premium prices for their products, resulting in gross margins of over 90%. And it's not just startups or smaller companies buying their chips. Nvidia's customers include the biggest names in tech, Microsoft, Apple, Amazon, and Meta, and so on. Now, these companies are locked in, relying on Nvidia's hardware to power their AI ambitions. But here is where things get interesting. Despite all this dominance, there are 5 major threats to Nvidia's position that could shake things up. Let's start with hardware innovation. History has shown us that markets always find a way to innovate around barriers. And in the case of AI hardware, there are already companies pushing the boundaries of what's possible. Take Cerebras, for example. They have created a single chip that's 57 times larger than Nvidia's H100. This massive chip eliminates the need for complex interconnect technology, which is a major bottleneck in traditional GPU setups. The result, Cerebras chip delivers 32 times the AI processing power per chip compared to Nvidia's best offering. Then there's Grok, another innovator in the space. Grok has developed a specialized design for AI workloads that achieves an astonishing 1,320 tokens per second processing speed. To put that in perspective, that's significantly faster than what traditional GPUs can deliver. And because Grok's design is optimized for AI especially, it offers a lower cost per computation when fully utilized. These breakthroughs shows that Nvidia's dominance in hardware isn't as unshakable as it may seem. The second major threat is customer independence. Here's the thing, Nvidia's biggest customers aren't just sitting back and relying on them for all their AI hardware needs. In fact, literally every single of these VIP customers is building their own custom chips. specifically for AI training and inference. Google is developing its TPU-v6 chips, which are tailored for AI workloads. Amazon is building Trainium 2 and Inferentia 2, designed to handle both training and inference at scale. Microsoft has announced its own custom AI chips, and Apple, with this expertise in custom silicon, could easily enter the space, but they don't do it. Even OpenAI, the company behind ChatGPT, is planning its own chip development. This trend of vertical integration is a direct threat to Nvidia's business model. And now let's talk about software moat erosion. One of the Nvidia's strengths has been its software ecosystem, particularly its CUDA platform, as you know, which has become the industry standard for AI development. But even this moat is starting to erode. The new frameworks are emerging that allow developers to write code that's hardware agnostic, meaning it can run on any chip, not just Nvidia's. Apple has Analyst, OpenAI has Triton, and Google has JAX. These frameworks are gaining traction because they offer flexibility and reduced dependency on Nvidia's hardware. And then there is AMD, which is making strides with open source drivers developed by George Hotz. These drivers could unlock cheaper GPU alternatives, further chipping away at Nvidia's dominance. Another major threat comes from a company called DeepSeek. Here's the kicker. DeepSeek achieved state-of-the-art performance in AI training using just 2,000 of the Nvidia's H100 chips, compared to 100,000 chips that companies like Meta are buying. And they did it for a fraction of the cost, just over $5 million. DeepSeek also released open source code and detailed technical documentation, making it easier for others to replicate their results. On top of that, they are charging 95% less for API access than competitors. This revelation is a wake-up call for the industry, showing that current practices are highly inefficient and that there is a pretty big room for massive cost savings. But there is another critical aspect we need to consider, the data center dilemma. Think about it. After you've trained your massive AI model, what happens to all that compute infrastructure? Sure, you could use it to train the next model, but here's the catch. GPU technology is advancing so rapidly that your 2-year-old cluster might already be obsolete. With electricity costs and operational expenses being such crucial factors, wouldn't it make more sense to use a brand new data center that's 20 times more powerful, even if it costs 10 times more? This reminds me an ASICs in mining of Bitcoins. The real challenge here is finding a way to recoup these massive upfront investments through positive operating profits. This creates a fascinating economic puzzle that few are talking about. Now let's talk about the market implications of all this. Nvidia's current valuations is pricing in a lot of good news for the company for the coming years. The company is trading at 20 times its estimated 2025 sales, which is incredibly high, by any standards. Its gross margins are at 75%, which is unprecedented for the semiconductor industry. To justify this valuation, Nvidia needs to maintain hypergrowth for years to come. But with multiple competitive threats on the horizon, hardware innovation, customer independence, software moat erosion, and the data center dilemma, there is a real risk that growth could slow or margins could compress. If that happens, the stock could face significant downward pressure. So what's the takeaway for investors? First, even the dominant tech companies face disruption risks. Nvidia may be the king of AI hardware today, for sure, but history has shown us that no company is invincible. Second, multiple competitive threats are converging on Nvidia, from innovative hardware startups to its own customers building custom chips. Third, the current valuation leaves little room for error. If growth slows or margin compress, the stock could take a hit. Fourth, innovation and efficiency gains could reshape the industry, making it harder for Nvidia to maintain their dominance. And finally, it's crucial to monitor both technical and market developments. The AI space is moving fast, and what's true today might be not true tomorrow. Remember, this analysis isn't just about Nvidia. It's about understanding how technology moats can erode through innovation. even for seemingly invincible market leaders. If you found this analysis valuable, don't forget to like and subscribe for more deep dives into market-moving tech trends and investing trends also. Drop a comment below with your thoughts on Nvidia's future. You can see my results as a portfolio manager here, and thanks you for watching. And remember, in tech, today's unassailable advantage could be tomorrow's legacy system.